Okay, so welcome everybody. I see we got a pretty good crowd tonight. We're going to be looking at chapter 4, which is merchandising activities. And what's different about chapter 4 from the first three chapters is a type of business that we're going to be looking at. We looked at companies in the first three chapters that sold mainly services or time to their clients, like Hawk Law, George Sinks, attorneys, Waldrop Plumbing. These are all examples of companies out there that sell time. But now we're going to be looking at a different type of company. And this type of company is one that actually sells merchandise. So examples of this are Target, Walmart, Lynch Appliance, your favorite convenience store. We're going to see how they do accounting so that they can go ahead and accurately reflect their revenue and their expenses. The expense part isn't really different. What really is going to be different is we're going to look at a different profit and loss statement. And as you can see in the slide, which is also exhibit 4.2, over to the right, Nordstrom Inc. has net sales at the top. Then it has cost of goods sold below that. Then it gives you a new line item called gross profit, and then we list the expenses. So the big new addition here is cost of goods sold, and this is essentially going to be linked to inventory, as we're going to see. So when you have a general journal transaction, you're actually going to have two. Every time you sell merchandise to someone, you're going to have two transactions. You're going to have the sale. So you're going to record what you receive in exchange for the goods, and then the credit to revenue. And then secondly, you're going to have a second transaction to reflect the reduction in inventory. So that's what we're going to be looking at this week. This gives you an idea of the cycle of what a retailer does or a merchandiser does. We start off with purchasing inventory. Once we purchase the inventory, it's usually a credit sale to us. And then, so that becomes an accounts payable. And then when we sell to the customer, it usually becomes either a cash transaction or an account receivable, depending on whether or not we give them credit or we're selling them the merchandise for cash. This is something to bookmark for now. We'll get into this later, but just wanted to let you know that merchandise available for sale is something that we're going to be looking at. I would need to pause here a minute. I got somebody in the chat. Somebody doesn't hear anything, and you might want to check your settings, check your sound, because I am not on mute. So anyway, getting back to the example here, we have net purchases plus beginning inventory equals merchandise available for sale. That makes sense. We're going to, if we've been in business in the counting period before, we're going to have merchandise on hand. And then we're going to add to that whatever purchases we brought in during the accounting period. And that's our merchandise available for sale. There's another way of looking at it. Another way of looking at it is we're going to take our cost of goods sold and add to that our ending inventory. So two different ways to look at merchandise available for sale. There's two different systems that we're going to look at. The one is a perpetual system. And this is where you're going to record the cost of goods sold at the time of sale. Examples of this are any modern food store or department store. Even convenience stores have perpetual systems. So when they get the merchandise in, they scan it into an inventory system on their computer system. And every time you check out, they're going to scan the item before you walk out the door with it. The perpetual system records when it comes in, and it records when it goes out automatically. A periodic system's different. Periodic system, you're actually going to have to take inventory at the end of each accounting period. So you're going to total up all the purchases through that period, And to determine what your cost of goods sold is, you have to actually take a physical inventory to determine what the difference is. Similar to what we did to supplies. It's going to be similar to that. Every time you go to the store now, though, you're probably doing a perpetual system. Used to be perpetual systems were only systems that, excuse me a minute, I have a 100-pound animal scratching at my door. I'll be right back. I apologize about that. She knows where I keep the dog treats. Okay. So getting back to periodic systems. I'm sorry, perpetual systems. This is by far the most common thing that is used now today. Used to be the only perpetual systems would be like car dealers. Something where you sell big ticket items where because of their expense, they have to be tracked. Jewelry stores were perpetual systems 20, 30 years ago because, you know, you got a $10,000 diamond ring, you want to make sure where it's at all times. But now they even keep track of where candy bars are at all the time through perpetual systems. So that's how much these have evolved. And if it wasn't for the computer, they would not be as popular as they are today. We're going to be looking first. We're going to have purchases with and without cash discounts. So the first scenario we're going to look at is we are buying from someone else merchandise that we're going to resell to our customers. Later on, we're going to reverse that role. We're going to look at what we do for accounting purposes when we sell to a customer. But right now, all we're focusing on is the fact that we have to buy inventory so that we can resell it to our customers. So when we go and buy inventory, transaction's relatively simple. We're going to debit merchandise inventory because merchandise inventory is an asset, and then we're going to credit cash. The other thing we might do is we might also credit accounts payable, because when we buy on credit from someone else, we have to do it through our accounts payable, or they're extending credit to us. Now, if we go and buy merchandise on account, in other words, the credit goes to accounts payable, not cash, we're going to be given a period of time to pay that vendor back. When I use the term vendor, supplier, I use them interchangeably. They're the same thing. They're the people that we buy stuff from, okay? So as we can see here, there's credit terms that cover the credit period. We have a discount period, which varies. We're going to use as an example, maybe 10 days at first, but it can be anything. You can have a 10-day discount period. You can have a 30-day discount period. You can have no discount period. The discount period is there in order to give the person paying the bill the incentive to pay it early. That's the only purpose of a discount period. Then you have the remainder of the credit period. And at the end of that period, if you don't pay your bill by the end of the credit period, and again, that can be any period of time, it can be 15 days, 30 days, 45 days, or even 60 days. The most common is 30 days. People want their money in 30 days. So when you go ahead and you pay after the credit period, you're going to get hit with a finance charge. Usually that finance charge is 1.5% or 18% interest per year. That's why that's the incentive for people to pay their bill as close to the end of the credit period or before to avoid those fees. When we do an invoice, and we're going to look at what one looks like in a minute, we give the credit terms in the invoice. And this is how it's going to appear in every invoice. This is a common practice in accounting, all right? So the first number is going to be the discount period. I'm sorry, discount percent. So if you pay your bill in 10 days, which is the number of days in that the discount's available, then you're going to get a 2% discount on the bill. And usually that's taken by the person who's paying the bill when they write the check and send it to the vendor. Then the N just stands for net, and the 30 stands for the number of days in the credit period. So if you don't pay the bill in 30 days, you're going to get hit with a finance charge. So you get no discount from day 11 through 30. You only get the discount in the first 10 days. And again, these numbers are not set in stone. I might want to, be cheap and give a 1% discount if they pay the bill in 15 days. So that would be 115 net 30. Might want to give them 60 days to pay their bill. So that would be 210 net 60. You get to decide. There are no hard, fast rules here. This is what an invoice looks like. And normally this is sent to the business after the merchandise is delivered. You can see that, let's see where it is. And item number 5, terms, you'll see the 210 net 30s designated there. We'll talk about FOB destination later. And we'll talk about purchase orders and that kind of thing later too. So our first example is we decide to buy merchandise to resell to our customers, and they give us a discount period. We purchase $500 of merchandise inventory on account. Credit terms are 210 net 30. So when we buy the merchandise, we're going to record the transaction as $500 debit to merchandise inventory, $500 credit to accounts payable. When we go to pay the bill, we have another transaction. And that transaction is a debit to accounts payable for the full amount of what we owe. Then we'll have 2 credits if we take the discount. The first is going to be a credit to merchandise inventory of $10. I'll explain that in a minute. And the second one will be a credit to cash for $490, which is the difference between the original purchase of $500 and the amount we owe after taking the $10 discount. Now, why do we credit merchandise inventory? Well, we credit merchandise inventory because if we go by GAAP and we go by the rules of reflecting what the actual cost of an item is, that we carry it on the books, that merchandise inventory just was lowered by $10 by taking this discount. So that's why it's always going to be a credit to merchandise inventory. Now, when we sell to our customers and give them a discount, it's going to be handled differently, and we'll see that later on. But when we're the buyer and we're taking the discount against a bill we owe, it will be a credit to merchandise inventory. This is what the T accounts look like when it gets posted to the ledger accounts. So you can see on the left, we have the debit to accounts payable for $500. Then we have the credit to merchandise inventory for $10 and the credit to cash for $490. Now, if we pay after the discount period, it's relatively easy. It's going to be a debit to accounts payable and a credit to cash. There is no discount if we make the payment outside the discount period. All right, next we have what's called purchase allowances and purchase returns. Purchase allowances is where you get a price reduction because the merchandise is defective. Let's say you order 500 blue widgets and they ship you green. Instead of returning them and going through the hassle of waiting for another shipment to come in, you call the supplier you call the vendor and say, look, let's make a deal. You screwed up. I don't want to send these back. I'll just paint them the color I want, but you need to make it right. And so maybe they'll give you a $200 discount. That's a purchase allowance. That's a $200 allowance on what you are merchandise that you bought. Okay. And a purchase return is pretty straightforward. You decide to pack it all up in a box and ship it back, and return it because for whatever reason. It might not have to be defective. It might be something you just changed your mind on, but that's a purchase return. So in our example, Z-Mart, the buyer, issues a $30 allowance from Trex for defective merchandise. Okay, I apologize. I didn't realize we were switching over now to be the seller of the product. I didn't think we got into that for a little while yet. But anyway, in this example, okay, we are issuing, oh no, we are, this slide was not made correctly. Okay, let's see, or are we Trex? Anyway, so we get an allowance for getting defective merchandise from the supplier. We're going to do a debit, $30 to accounts payable, and a credit for merchandise inventory for $30. So what this is we're essentially, taking off the bill the $30 allowance that they gave us because something was defective, but we decided not to return it. Maybe it was, I don't know if it was a bicycle, maybe it had a bent handlebar and we were able to bend it back in place. I don't know. But in this is an example of how you handle an allowance for something you bought. In our purchase return, now they make this a little bit more complicated, so pay attention. Z-Mart purchases $250 of merchandise on June 1st with terms of 210 net 30. That means we're going to get a 2% discount. Or no, sorry, net 60. If we 2% discount, if we pay within 10 days, but we got 60 days to pay the bill. On June 3rd, which is 2 days later, we returned $50 of goods before paying the invoice. And then when we pay the invoice on June 11th, within the discount period, we take the 2% on the remaining balance. So the first transaction, as you can see, we have a debit to merchandise inventory of $250. Then we have a credit for accounts payable of $250. So that sets up the bill that we owe that we have to pay at a later date. Next, we return the merchandise. So we're going to debit accounts payable $50 and we're going to credit merchandise inventory. Makes sense. We don't owe them the $50 for what we returned anymore, and we no longer have it on hand, so we have to reduce the inventory. And if you remember, the normal balance of merchandise inventory being an asset is a debit, so we're going to credit that account to show the reduction. Finally, we pay the bill on June 11th. So when we go to pay the bill, we only owe $200, all right? We've returned part of the merchandise, so the balance that we owe the supplier is $200. We're going to go ahead and take our discount, which is $4, and that's going to be a credit to merchandise inventory. I explained that earlier. And then the difference is $196, and we're going to credit cash. Speak up if you have any questions, and to stop me if you want me to stop and explain something further, okay? I can't see this chat at this point because I have it minimized. All right, I told you we're going to talk about shipping points and destination. And this is important because if it's FOB shipping point or FOB destination, that makes a difference as to who owns the goods. The shipping point is the loading dock of the people you bought it from. The destination is your loading dock. So if we're FOB shipping point, that means that when the truck leaves the loading dock from who we bought it from, we own it. We are responsible for it. We're going to pay for the insurance. We're going to pay for the cost of shipping, et cetera, et cetera. If it's FOB destination, we don't own it until it gets to our doorstep or our loading dock. And that means the seller takes on all the expenses of shipping, whether it be storage or insurance or just the cost of moving it to us. So that's the difference. Okay. And this is going to come back after this chapter. So on some other areas we're going to look at. So it's important you understand the differences here. So how do you handle transportation costs? Well, when we buy from someone else, we're going to adjust inventory. So when we purchase merchandise, to be shipped to us, FOB shipping point, and we're paying $75 for the transportation cost, it's going to increase our merchandise inventory because that's part of merchandise inventory. So we're going to debit merchandise inventory $75, and we're going to credit cash $75. Or it might also be in accounts payable. Okay, now when we go to record all this stuff on an income statement, it's a little bit expanded now. All right. So first we have to look at the itemized cost of the merchandise purchases. So if you look here, it says invoice cost of all purchases during the period were $235,800. Then you'll see that there's two other accounts listed below this. So the first one's purchase discounts received, and you can see it's a negative $4,200 or $4,200 in parentheses. And then purchase returns and allowances are $1,500 as well. Then we're going to add in the cost of transportation, which we're going to add $2,300, and that's going to give us our net cost of merchandise purchases. And I would definitely bookmark this exhibit in case you run into a problem or a question that wants you to list it out this way. And I think there's a couple. All right, next we're going to calculate gross profit. This is what you're looking at here goes on the income statement now. All right, this is only a small section of the revenue section on the income statement. We'll see how it all comes together at the end of this chapter. You can see that there's net sales of $314,700, and then there's cost of goods sold, which is $234,000. So we're going to subtract that from net sales, and that's going to give us gross profit. After we determine gross profit, then we're going to subtract all of the operating expenses in our business. Now, what are cost of goods sold? Well, cost of goods sold, we're going to have to determine exactly what each item cost us that went out the door. And that's exactly what determining what cost of goods sold is. And there's a couple different ways of determining this. So as I talked about earlier, each transaction is going to have two parts. We're going to have to record the revenue being taken in, and then we'll have a second transaction right below it to calculate cost of goods sold for that. If you look at the revenue side, let's see, Z-Mart sold $1,000. Now we are the seller. Okay. So we sold $1,000 of merchandise on credit. The merchandise has a cost basis to Z-Mart of $300. Cost basis means that's what it cost us. That was what we have in it before we sold it to the customer. So you can see that a business has to keep track of the cost of each and every individual item. And I can tell you a lot of small businesses do a very poor job of doing that. So under accounts receivable, we're going to record a debit of $1,000 because they're buying it from us on credit. Then we're going to record the sales of $1,000. Notice it doesn't say revenue, it says sales. And we'll be referring, but it's the same thing. You can use the two terms interchangeably. It's just that when we're selling to somebody, we call it sales. Next, we have to record what the cost of goods sold was. So the merchandise that we sold for $1,000 cost us $300. So we're going to debit cost of goods sold, $300, and we're going to credit merchandise inventory because now we don't have it in the store anymore. It's gone. So we have to do a credit of merchandise inventory, $300. Now, if you think about this, what is also a debit on the income statement? Because this is going to go on the income statement, the cost of goods sold. Expenses, okay? So if you have a hard time understanding why we're debiting cost of goods sold on each and every transaction where we sell something, just think of it as an expense, okay? It costs us, but it's not going to go with the expenses. It's going to go up where the sales are. So that's what you have to keep in mind. Again, we're going to treat our customers the same way we've been treated when it comes to extending credit sales to them. There's a credit period, there's a discount period. If they get a discount, they have to pay us before the discount period is up. All right, so sales with cash discounts. What happens if when we have a sale where we're going to extend a discount to a customer for paying early? Well, as you can see, on November 12th, we sold an item for $1,000. And this is identical to what we just looked at. Debit to accounts receivable for 1,000, credit to sales for 1,000. Then a second transaction occurs at the same time where we record the cost of goods sold, debit for $300, and a merchandise inventory credit for $300. So that completes the sale. When we go and the buyer pays within the discount period, we are going to get $980 in cash. So that's going to be a debit. We're going to debit sales discounts, new account here. It goes up underneath sales. You'll see where it goes on in a few minutes. And then we're going to credit accounts receivable to eliminate that account because they don't owe us anymore. If they pay after the discount period, well, we're going to debit cash 1,000, and we're going to debit accounts receivable 1,000. Pretty straightforward. What are sales and returns allowances when we're the seller and they're the buyer? Okay, well, we already talked about, what these are. And it's the same thing when we're the seller as what happens is when we're the buyer. They decide to return something, we have to record it as a return. If we decide to give them an allowance because they want to keep it, but they want us to reduce the price to give them the incentive to keep it and not return it, then that's called an allowance. So in our example, a customer returns merchandise was sold for $15 and cost $9. So when they go and return it, we're going to have a debit to sales, returns, and allowances. And then we're going to have a credit to cash for $15 to show that we took the merchandise back and gave them their money back. But there's a second transaction. If the goods are not defective and we decide to put them back on the shelf and sell it, we're going to have a debit to merchandise inventory, and we're going to have a credit to cost of goods sold. Why are we having a credit to cost of goods sold? Well, because when we sold the item to the customer, all right, we added that to the total cost of goods sold by debiting that account. Now we have to reverse that transaction. And the only way we can do it is by doing a credit to cost of goods sold. So those are the two entries you want to make. Okay, so what if they're given an allowance? It's pretty straightforward. We're going to debit sales, returns, and allowances for whatever we agreed to, reduce the price on, and then we're going to give them that amount of money back by crediting cash because they decide to keep it. They just wanted a little bit of their money back for keeping it. And by the way, if you, it's the same process. If you go and you buy a discounted item from a retailer too, they're going to record the discounts the same way. All right, this is the flow, the cost flow in the accounting cycle. So you can see that from the supplier, we get our net purchases. The cost of goods sold is going to go to the income statement. The ending inventory for the period is going to go to the balance sheet, or merchandise inventory, or more exactly. All right. And then if you look at this chart, and if you have a tough time seeing this, go to exhibit 4.1. Your ending inventory for period 1, let's say 2021, becomes your beginning inventory for 2022. And the whole process starts over again. All right, so what happens if you have shrinkage? I mean, every business has shrinkage. I'm sure you've been in a Walmart or a Target where you see people walking around and putting tags on shelves, and they got this big machine they're typing on like a calculator as they're doing inventory in a particular store. They're trying to determine, even though the store is on a perpetual system where it scans everything, even a store as large as Walmart will scan everything into their system to see if it's sold, or rather to record that it's sold. Okay. They still have to take inventory at least twice a year to see if anybody's stolen anything, or to see if breakage hasn't been recorded, that kind of thing. So that's called shrinkage. And it's usually due to theft, by the way. That's the most common way that businesses don't capture stuff going out the door. Although you could have breakage, and if you don't have a breakage recording system in your store to adjust your numbers, it's going to come up here. So when we're looking at making an adjustment due to loss of merchandise, we're going to put it into cost of goods sold. We're going to act as if we sold it. So you can see here in our example, cost of goods sold was debited $250. And because we're missing that $250, it should have been in inventory and it's not, we're going to credit merchandise inventory. All right. And as you can see, the revenue recognition rules require reporting of sales at the net amount expected. So adjusting entries are required for expected sales discounts, expected returns and allowances on the revenue side and on the cost side. All right, so these are the closing entries that you're going to do when you're a merchandiser. And as you can see, that when you go to close out sales, you're going to close it out to the income summary the same way you did revenue. No real difference there. Where the difference is going to come in is now when you close out sales discounts, returns and allowances, and cost of goods sold, which all have a normal balance of debit, they're going to get added to the expenses. Not really a big difference. You just have to remember to add them in. So the closing procedures are essentially the same. You're just adding the new items we discussed today into the part of the income summary that captures the expenses to close those out. This is a good chart to bookmark 4.12. It might help you in determining what your entries need to look like when you're doing your homework problems or answering your quiz questions. Let's see. The adjusting entries are essentially are mainly, adjusting for shrinkage when we're talking about merchandiser. And you can see that when you're doing your closing entries, the change is really only adding the 3 accounts that I listed to your expenses on that side of the income summary. Now, we're going to have a different income statement. I wish I could make this bigger. If you can't see it, I'm going to read you. The top line is sales. That is total sales. Okay. So every time you have a sale, that's where it's going to go, is on that top line. Next, we're going to have sales discounts, which are indented to the left, and sales returns and allowances, which are indented to the left. Again, they're normal balances or debit. What's that like? Expenses, okay? That's the way you got to think about it. You're going to take the difference between your sales, discounts, returns, and allowances and your sales, and that's going to give you net sales. And that goes right below sales, returns, and allowances. Next, you're going to have a line called cost of goods sold. And that's going to go below net sales. And then you're going to subtract that from net sales. That's going to give you gross profit. Then you can see that now the income statement is broken up between selling expenses and G&A expenses. All right, so what are we talking about? Well, let's say you're a car dealer. All right. Your expenses that deal with selling cars are going to go under selling expenses. Examples are the sales personnel salary or commissions, advertising, the office space that they're taking up in your building. Okay. So if you're renting the building, you're going to break it up to how much space they occupy. So those are examples of selling expenses. Now, general administrative, well, your accounting department, you know, the finance guy you see before you leave that does all the paperwork. Everything associated with them goes under general and administrative expenses. And this is the way it's normally broken up in companies that are merchandisers. Now, you know, you got a little convenience store or hardware store. You're not going to break it up like this. You're going to list all the expenses in one big line, one big column. But, you know, the more sophisticated you get, you're going to break up selling expenses and G&A expenses. And then you're going to have income. I'm sorry, you're going to have total operating expenses, which are totaling the two up. And then you're going to subtract that from your gross profit, and that gives you income from operations. Now, if you look down below, you'll see that there's interest revenue that's a plus, gain on sale building that's a plus, and interest expense that's a minus, but we won't be getting into those until later on. The important thing that you understand, in fact, probably not to the last week, important thing you understand is just to see what this new income statement looks like. You want to bookmark this. You want to refer to it while you're doing the problems so that you're not being gigged for getting the problems wrong. This is a simplified income statement, but it's essentially laid out the same way that we looked at it. And it's called a single step statement. Now here you can see that we put all of the gains and revenues up at the top. Remember, we had interest revenue below what they call the profit line. Now it's up there with the revenue and the gain on sale buildings up there. We're not going to be using this. All right. This is just to expose you to what this looks like. You can see the cost of goods sold now goes under expenses under this example. So does interest expense. But again, you're not going to be tested on this. This is not something that you're really going to be seeing after tonight. Next, we have what's called the classified balance sheet. I believe we got into this last week where we looked at where, what are current assets, what are current liabilities and stuff like that. Merchandise inventory is considered a current asset. Why? Because you're going to get rid of it in less than a year, because you can make it is somewhat liquid. Okay. Theoretically, you can have a 50% off sale and it'll bring money in. It might not, it might hurt your profit, but technically it's a way of raising money. And that's why it's put in here with all the other current assets. Okay. Our ratio of the week is the acid test ratio. This is your quick assets divided by your current liabilities. What are quick assets? They list them here: cash plus short-term investments plus your accounts receivable. They're all highly liquid. Your acid test ratio should at least have a value of 1. All right. If you have at least a ratio of 1, chances are you're not going to have a problem paying your bills. Okay. If it's better than 1, you have less of a chance of going bankrupt. And this is Nike and what their ratio looks like compared to Under Armour. And I'll let you look at that and analyze that, see how that all fits in. Next, we have the gross margin ratio, and that is net sales minus cost of goods sold divided by net sales. All right. So in other words, you know, you could also call this your gross profit ratio. And this is letting you know how much you have left over on a percentage basis to cover your operating expenses. A lot of times when you're running your business, it's a lot easier to see differences when you're looking at percentages than when you're looking at raw numbers. And what you would do with this ratio is if you're going to like buy stock in a company and you want to see how their gross margin, you know, measures up to others, you know, maybe you'll compare Target. I'm trying to think of a department to Macy's. All right. You might, or Target to Walmart. And again, you'll track right here. We track the gross margin here of this company from 2 years ago to 1 year ago to the current year. It was at a 44.6. It dropped to 43.8, which means it had less money to cover expenses, which means it probably made less profit. But then it shot back up to 44.7%. And it's looked like they somewhat got their act back together. That ends the chapter. Does anybody have any questions on what we covered? You can unmute yourself if you have any questions. All right, I think last week I forgot to give you all the phrase that pays so you can do your survey. This week is the 100-pound dog that tried to break into my office here at home is named Elsa. So the question will be, who is that dog that tried to break into the office? And that's Elsa. She's a 100-pound Great Pyrenees, and she can be stubborn. She knows I keep all the treats in here. If you have any questions, again, don't hesitate to email me. Please pay attention to the announcements. I'm probably preaching to the choir here, but it seems like every other day I get someone asking a question that appeared in an announcement in the last week or two. So I try to remember to check the email box so you'll get an email and the announcement, but it's the only way I have of communicating with you guys. So please pay attention to them. And please, if you have a question, don't reply to an announcement. Make sure you put your section number in, make sure you put in the subject line what you're emailing me about so that I don't have to go searching through 3 classes to find out who you are. Okay. All right. With that, good luck on your test if you haven't taken it, and have a good week. And we'll meet again next Sunday night.